Welcome to Talk Tickers. We're diving straight into the Q1 2025 earnings call for World Connect Corporation today.
And it's definitely a mixed picture coming out of this quarter.
Yeah, exactly. So our goal here is to really unpack what these results mean, especially for experienced investors like you listening in. We'll hit the key numbers, look at the strategy shifts.
Yeah, and pull out those crucial insights.
Yeah.
Okay, so let's start with the top line numbers.
Go for it.
Right, so consolidated volume, it was actually down 5% compared to last year. Came in at 4.2 billion gallons.
Okay, 5% down. And that impacted profit.
It did. Consolidated gross profit slid 9% year over year, landing at $230 million for the quarter.
Yeah.
But, when you break it down by segment, things look quite different.
Absolutely. Aviation seemed to be the real bright spot here.
Definitely. Volume was up 2%.
Okay.
And gross profit up a solid 7%. That's pretty good momentum.
It really is, especially considering they sold off that Avinode business. Wasn't it Q2 last year?
Exactly. And Avinode contributed about, I think, $10 million in the prior year's Q1. So seeing profit up despite that sale.
Yeah, that suggests some real underlying strength, maybe in their European airport ops or general aviation.
Could be both. The call mentions strength in European operations and also better inventory results and profitability in general aviation.
Yeah.
So yeah, it seems quite robust.
Right, but then you look at the land and marine segments, quite a different story.
Oh, absolutely. Land faced some significant headwinds. Volume dropped 6%.
Okay.
And the adjusted gross profit, that took a pretty big hit, down 19%.
19%, wow. And marine wasn't much better.
No, marine saw declines too. Volume down 14% and gross profit fell 26%.
So what's driving those drops? Land first, maybe?
Well, for land, it seems tied to the North American liquid fuel business. Broader market trends, maybe some economic softness impacting volumes and margins.
And then marine, what's the pressure there?
A few things, it seems. Lower bunker fuel prices definitely played a role. Less market volatility compared to maybe a year ago. And just general uncertainty, in global shipping. Shifting trade policies, that sort of thing.
Right. Didn't they mention Singapore volumes being low?
Yeah, near a 2-year low for bunker fuel volume in Singapore, which is a huge hub.
Yeah.
So that kind of underlines the caution in global trade right now.
Okay, so pressure on land, pressure on marine, strength in aviation. But interestingly, their cash flow looked pretty healthy.
It did, yeah. Operating cash flow came in at $114 million.
And free cash flow?
$99 million. Pretty strong numbers there.
Which allowed them to keep buying back shares too, right? About $10 million.
That's right, $10 million in repurchases in Q1. It shows maybe some confidence in the underlying value or just a commitment to returning capital.
Although they did signal free cash flow might be lower going forward than that Q1 number.
Yeah, that's something to watch. Q1 might have been particularly strong on the cash front.
Okay, let's talk guidance. What are they signaling for Q2?
They're guiding Q2 gross profit to be somewhere between $235 million and $244 million.
So potentially ticking up a bit from Q1's $230 million.
Exactly. Suggests maybe some stabilization or improvement is expected.
And the tax rate.
They tweaked the full year adjusted tax rate guidance down slightly, now looking at 22% to 24%.
Not huge, but every little bit helps the bottom line, I suppose.
Right. It boosts net income directly.
Now, there were some big strategic moves announced or completed around the quarter, too, that UK land business sale.
Yes, completed in April after the quarter ended, but it resulted in a big one-time charge in Q1, $110 million non-cash pre-tax.
And what was the thinking behind selling that UK business?
Well, it seems it was dragging things down. It represented about 375 million gallons annually, mostly in Q4 and Q1.
Okay.
But it actually generated an operating loss last year. And it faced challenges with, UK weather trends affecting heating oil demand, plus the whole energy transition there.
So offloading a problem asset, basically. Did they get much cash for it?
About $50 million in cash proceeds, it sounds like. So they cut the losses and get some cash to potentially redeploy.
Makes sense. And they also mentioned a restructuring charge.
Yeah, a $15 million non-GAAP charge in Q1. This was mostly for headcount reductions, kind of across the board.
Okay, trying to cut costs. Any idea how much savings that's expected to generate?
They're targeting $30 million in annualized cost savings from this.
$30 million annualized. That's pretty substantial compared to the charge.
It is. They expect to see the full quarterly run rate of those savings kicking in by Q3 this year.
So these moves selling UK land, the restructuring it all, points towards that strategy they've talked about, right? Streamlining the portfolio, cutting fixed costs.
Exactly. They're clearly focusing their efforts, selling the UK business, and they'd already sold the Brazilian one earlier. It really concentrates their land focus now on North America.
Right. Let's dig into that North American land strategy then. They've shed the international parts, so what's the plan now?
The idea is to get greater scale and better operating leverage just by focusing on North America. They seem pretty optimistic about improving profits there.
When do they expect to see that improvement?
They're talking about the second half of 2025, driven by, consolidating IT platforms, the cost cuts we just mentioned, and just right-sizing capacity.
So even though they just sold off a chunk of volume with the UK business.
Yeah, interestingly, they expect Q2 land gross profit to actually be up year over year, despite the divestitures.
Okay, that's ambitious.
And they expect even stronger improvement in the second half. So they must feel the remaining North American business has potential and the streamlining is working.
Did they mention any specific challenges within North America, though? It can't all be smooth sailing.
No, they did flag a couple things. Some customer disappearances, as they put it, on the East Coast in their card lock business.
Competition, maybe?
Could be. And also margin pressure out in California, apparently related to major refiners shifting towards renewable products, impacting traditional fuel supply dynamics.
Right, the renewables transition, that's a big structural shift.
Definitely. So while they're aiming for this material step change in operating margins, targeting 30% versus around 25% now.
30% is a big jump.
It is. Achieving that will mean navigating these regional headwinds pretty effectively. It's a key thing to watch this year, I think.
Okay, so land is a turnaround story in progress. Let's flip back to aviation. You said it was strong. Is that expected to hold up?
Seems like it. The momentum from 2024 carried into Q1. They highlighted good performance from European airports, strong inventory results, general aviation doing well.
And the Q2 outlook?
They expect Q2 volume and gross profit in aviation to be pretty similar to Q2 last year, which was already strong.
So fairly resilient then. Any specific weak spots they mentioned?
Only potentially some softness in domestic leisure travel demand. But otherwise, the core business seems quite solid. It's definitely providing a stable base right now.
Okay. Now, what about marine? It was down significantly. Any glimmers of hope there?
Well, the overall expectation for Q2 is still for gross profit to be down modestly compared to last year. The global uncertainty hasn't really gone away.
Right.
But they did mention one potential sort of specific upside. The Mediterranean Emission Control Area, or ECA standard change. That kicked in May 1st.
New regulations. How could that help them?
It could create some short-term supply and demand imbalances for compliant fuels in the Med, maybe some logistical hurdles that companies like World Connect could potentially profit from.
So a tactical opportunity, perhaps, rather than a fundamental market shift.
That's how it sounds, yeah. More of a potential Q2 specific event than a sign the whole marine market is turning around just yet.
Understood. Let's talk costs and financial health more broadly. They took the restructuring charge, but how are operating expenses looking overall?
Actually pretty good in Q1. Adjusted operating expenses were $178 million. That's down 6% year over year and was below their own guidance.
Okay, so cost control measures seem to be biting already.
Seems so. And they expect Q2 OPEX to be in the range of $175 to $179 million, which would be another year-over-year decline.
And interest expense, still benefiting from maybe better working capital management.
Yeah, interest expense was down year-over-year too, and in line with guidance. They expect it to be between $24 and $27 million in Q2.
So costs generally moving in the right direction, strong cash flow in Q1, continued buybacks. The financial footing seems relatively solid despite the segment pressures.
I'd say so. The balance sheet looks strong, and they emphasize disciplined working capital management. That gives them room to navigate these near-term challenges and execute the strategy.
And that strategy remains pretty consistent, right? Focusing on streamlining, cost cuts, leveraging their distribution expertise.
Exactly. It's about simplifying the business, improving margins in the core North American land and aviation segments, and using that strong balance sheet.
Are they still open to M&A, or is it all about internal fixing right now?
They mentioned being open to it, yes. Said seller expectations are maybe becoming a bit more sensible, but the priority seems to be value and return on investment, not just doing deals for the sake of it. Internal optimization seems key right now.
Okay, so putting it all together for an investor, it's a company clearly in transition.
Definitely. Shedding non-core assets, doubling down on North America land and aviation, and really focusing on efficiency.
The divestitures signal that focus pretty clearly.
Yeah, getting out of UK land sends a message. The cost cuts are starting to show up in the numbers, and they promise more.
Aviation provides that crucial stability.
It does. It's the anchor right now. Land is the big turnaround project to watch.
And marine remains a bit of a wild card tied to global trade and fuel prices.
Right. Though that Med ECA change is a little wrinkle to keep an eye on in Q2.
So the key things to monitor are really the execution on cost savings and whether they can meaningfully improve those North American land margins.
Absolutely. That's where the potential upside beyond aviation stability seems to lie.
Okay, let's pivot slightly. This is not financial advice, purely speculative thinking here.
Uh-oh, here we go.
Right. So they're divesting legacy fuel businesses, focusing on North American distribution, facing pressure from renewables. What if you took a really long view?
Okay.
Could World Connect leverage its last half-mile expertise, its relationships with commercial customers, its balance sheet, and pivot towards electrification infrastructure?
You mean like getting into EV charging?
Exactly. Maybe not building chargers themselves, but acquiring or partnering with a major North American EV charging network focused on commercial fleets. They know logistics, they know fueling.
That's definitely thinking outside the current box. It would be a massive strategic shift.
Massive shift, high risk, totally speculative. But if you're thinking about where energy distribution is going long term, it's an idea, right?
Yeah.
Using their existing strengths in a new energy paradigm.
It's certainly a provocative thought, leveraging core competencies in a disruptive way. But yeah, miles away from their current earnings call commentary.
Absolutely. Just some food for thought. And definitely not financial advice.
Definitely not. As always, you need to do your own thorough research and understand all the risks before making any investment decisions.
Well said. So that wraps up our deep dive into World Connect's Q1 2025 call. We've hit the results, the strategy, the cost cuts, the segment performance.
A little blue sky thinking at the end there.
We did. So what do you make of this sharpened focus on North America? Do you think a cost savings will really hit that 30 million mark and boost margins?
Lots to watch in the coming quarters.
Indeed. Let us know your thoughts. Remember, this was just our take on the call, purely informational. Always do your own homework.
Thanks for tuning in.
We'll catch you next time for another earnings call breakdown right here on Talk Tickers.